The second and third largest bank collapses in US history transpired over the weekend. In one of the most shocking developments to hit the banking sector since the global financial crisis of 2008, Silicon Valley Bank, or SVB, failed on Friday, March 10th after a sudden rush of withdrawals. SVB was well known for its links to the VC and tech industry and had $209 billion in assets under management. It failed and was placed into receivership under the FDIC. On Sunday, the contagion hit New York-based Signature Bank, which also failed after a bank run by spooked investors. With $118 billion of assets under management, Signature is the third largest banking collapse in US history. And in an effort to shore up confidence in the banking system, the Treasury Department, the Federal Reserve, and the Federal Deposit Insurance Corp, or FDIC, stepped in with several measures, including an assurance that all Silicon Valley Bank and Signature clients would be protected and able to access their money. Now, the FDIC typically insures deposits up to $250,000 US, but in an unusual move, regulators announced that all Silicon Valley Bank and Signature customers would have access to their deposits, including those with more than $250,000, which in fact was the vast majority of SVB's domestic deposits. Regulators also unveiled a new way to give banks access to emergency funds, making it easier for banks to borrow from it in a crisis. And President Joe Biden is trying to calm the waters, saying that the US will do whatever is needed to shore up the banks and that Americans should, quote, rest assured that our banking system is safe. But just how safe is the banking system? What are the ramifications for this, for the economy and the Fed's next moves, and your portfolio? Well, joining me to discuss these rapidly changing developments is Matthew Piepenburg. He is the commercial director of Matterhorn Asset Management and the author of several books, including Gold Matters, Real Solutions to Surreal Risks. Matthew, welcome back to Kitco.
It's great to be back, Michelle. Lots to discuss today.
Lots to discuss. We may be, in fact, on the verge of a surreal risk. So I want to start off by helping our viewers understand what happened here. Just as a recap, Wednesday, March 8th, SVB announces a loss of $1.8 billion from the sale of investment securities. And at the same time, SVB's holding company announced intentions to raise $2.25 billion to shore up the bank's capital. Now, rather than comforting investors and depositors, has had the opposite effect. The surprising announcement spooked the markets, causing a run on the bank. And then within a few hours, we had depositors withdrawing over $42 billion in cash, approximately 25% of total deposits. That left the bank with a negative cash balance approaching $1 billion. And by the end of the day on Thursday, unable to shore up the shortfall overnight, the bank failed, and it was then placed under the FDIC as receiver. All right, that's kind of how we got there. But a lot of the problem with Silicon Valley Bank, Matthew, seems to come down to interest rate risks, which the bank's executives failed to plan for, as the Federal Reserve has obviously been very aggressive with its rate hikes over the last year, and keeping in mind that over 57% of SVB's assets were in marketable securities, comprised mostly of US Treasury securities and mortgage-backed bonds. So, Matthew, explain what happened here.
There's a lot you've hit on. I mean, you've hit the issue of the banking risk, you've hit the issue of securities risk, you've hit the issue of Treasury risk and bond risk and Fed policy, and then, of course, now a new banking crisis, which was in many ways very different and very familiar to the 2008 crisis. It's a run, as you said, which is a little bit different than what happened with Bear and Lehman and Citi and even Goldman Sachs, which played both sides of the CDS MBS trade. I think before you can even get into Silvergate or Silicon Valley Bank or even Signature Bank and maybe even now First Republic, before we get into the details of the analysis of the failure, you have to put it in a broader context. I think I would, at least for 30 or 40 seconds, just because it's important to realize that with so many needles pointed at this red credit balloon, that there was something bound to hit that balloon. And in this case, it's now the headline du jour is a new banking crisis, the 2023 version. And I think this is all within the theme of what we've been talking about for the last 12 months, really since, Powell or the Fed began tightening into the greatest credit crisis in history, that something was going to break. There was going to be a credit event in the markets. And I just wrote an article, I think 3 weeks ago in February, about the sovereign bond market, which does tie into SVB and Silvergate and these other banks, that there were three moments of total dysfunction in the credit markets just in the last few years. The first one, of course, was the repo crisis in 2019 in September, which was, you cannot underestimate the significance of the leading indicator, what that meant for bonds and banks. That repo crisis basically said that large commercial banks didn't trust each other's collateral, which was US Treasuries. And so the Fed had to come in and be the lender and eventual spender of last resort to help the big banks, the big commercial banks. Then you had the COVID crisis in 2020 in March, where stocks and treasuries and bonds in general fell together. And then just last October, you had the gilt implosion in the UK across the pond. And I wrote 3 weeks ago that there's going to be a fourth moment. All these cracks in the ice in the credit markets are going to affect banks, and it's going to be a fourth moment. And just, of course, Friday, that fourth moment came, and we had another banking crisis. And to your point, this banking crisis, the version 2.0 in 2023, is different than 2008 for a number of reasons. The key word that I agree with, Michelle, is it's a run. It's a run on the bank. That's what happened at Silvergate prior to, Silvergate went into a voluntary liquidation, and it had 6 billion deposits. SVB had over 170 billion. So it was a different headline, a bigger story, but it was a run on the bank. And that's different than what happened. It's important for people to realize it's different than what happened at Bear Stearns or Lehman or these other banks in 2008. What you had in 2008 were these mortgage-backed securities, these toxic, subprime mortgages, which were paraded as AAA credits or investment grade credits by the rating agencies like Moody's or S&P, was really just horse crap wrapped in tinfoil and sold as diamonds. And that created, people woke up the next morning and realized their bank's asset side of their balance sheet had tanked overnight. There was a loss of faith in the balance sheet. What happened at Silvergate and at SVB and now at these other regional banks is, prior to the headlines, there was a loss of faith in the assets and the collateral and the I guess the loans of these type of banks. And this has a lot to do with this blender of forces: the tech market, liquidity, banking risk, and the Fed is in front of, behind, above, and beyond all this. Fed's fingerprints are all over this. But at Silvergate and at SVB and at other regional banks, what happened in Northern California last week was, prior to an asset devaluation, there was a loss of trust in the collateral in the banking system, which had to do with their measurement of risk. And a lot of that has to do with the ripple effects of FTX and Sam Bankman-Fried and the crypto exchanges and crypto-linked accounts, which were at Silvergate, or startup investments, yesterday's unicorns, which are now tomorrow's donkeys, as these growth stocks and tech stocks head towards a mark cliff, which is the first stocks to get hit. And from my conversations with folks in Northern California, the VC environment was already talking to clients and folks about the risks in the collateral and in these tech stocks and these banks. And so what you had was a run. A run is very different because it's a lack of confidence before. And this is directly tied to your point on how these banks have underestimated the power of the Fed and how the Fed is still involved in this. Because when there's a run on a bank, it's like any Ponzi scheme. The fastest runners are the first out and the first to win. The slowest runners get burned. It's like a theater, which I wrote about. When it catches on fire, the exit door is the size of a mouse hole. And so as these kind of lack of confidence, these collaterals, these depositors started to take their money out, banks like SVB or Silvergate were forced to sell assets to meet depositor demand. But this is how the Fed comes into the play, Michelle, because the Fed, by raising rates all these months, quarter after quarter, BIP after BIP, 25, 50 here and there throughout 2022, what that does is you raise the rates. Well, you know that bond price and rates are inversely correlated. So the bond prices went down. And so these banks, which were faced with liquidity needs by their depositors, had to sell those short-term notes, those short-term treasuries, not at maturity, but prior to maturity at the worst time at a discount. And then they had to sell out their loans. So they did not have enough liquidity to meet all the demand. And of course, that's when all the trouble started. And as the vicious circle got farther and farther down, there was less and less funds available. And of course, they were sent into receivership. Silvergate went into voluntary liquidation. But you see how the Fed's policies affect everything. Behind every market crisis since 2000 itself, and even prior, there's always a central banker with his head down and his hands behind his back, trying not to say anything, because there really is fingerprints all over this. And again, by raising rates, you're putting pressure on the credit markets and you're putting pressure on the financial markets. I think for so many years, or so many months, we're talking about the Fed, but even the banks can't fight the Fed. We talk about how the QT policy affects, the balance sheet of the Fed's balance sheet by 300 billion, from 9 trillion down 300 billion, or affects CPI inflation, but it also affects these banks. It's
Right.
just another one of those needles that hit the balloon. And so, yeah, by having to force sale treasuries at a discount and loans, it put these banks out to pasture faster than they should have. And the loss of faith in those banks, not a coincidence that it started in a tech sector in Northern California, because there's a loss of faith in tech too. And so it's all connected, Michelle.
Right. And as you say, the Fed raising rates impacted what ordinarily would be safe collateral. I mean, 57% of SVB's assets were marketable securities, mostly US Treasuries. And then we had this rapid rise of interest rates over the past year, and the market value of the bonds fell substantially. And of course, that doesn't matter if a bank is able to hold the bonds until maturity, when they'll be repaid at par. But if a bank is suddenly forced to sell them, as they were, to generate liquidity to meet the demands of depositors, then the bank was forced to sell them at a loss because the Fed was hiking rates there. Now, obviously, contagion is the big concern. And then we had the Fed on Sunday announcing that it would make additional funding available through a new bank term funding program, which would offer loans of up to 1 year to depository institutions backed by treasuries and other assets that these institutions hold, so that people wouldn't have to take a haircut on previous treasuries. So break down those measures that regulators have taken.
Yeah, it's important because I think, the Fed's biggest fear isn't even a correction or a 20% market correction or highs and lows or peaks and valleys. The Fed's biggest fear is contagion effect, whether it's in the banking sector, whether it's in the whether it's any particular risk asset sector. And I think in this particular case, their biggest fear is a spread of, I hate to use the word, of viral fear within the regional banks that then spreads to the commercial banks. And so they've come up with some, over the weekend, the headlines change every 10 minutes, but they came up with some emergency measures. There is, as you said, the FDIC does insure bank deposits up to 250,000. But in the case of Silicon Valley Bank, 95.5% of those assets weren't covered by the FDIC. So then over the weekend, since Friday, they thought, well, the FDIC has this thing called the systemic risk exemption. Well, they'll go above their $250,000 cap. But even that was just a dent given the massive amount of liquidity the bank needed. And then, of course, there was the infamous bank term funding program, the BTFP, which has eerie reminiscence of the TARP, or the Troubled Asset Relief Program, this new idea that $25 billion to come from the BTFP, which is really just a portion of the $38 billion at the U.S. Treasury's, it's called their Exchange Stabilization Fund, but it's $25 billion of that $38 billion. There are many who would argue, and I would argue, that's probably not going to be enough. And then so that really is a Band-Aid on an open knife wound. And the question is, will $25 billion be enough to stave the contagion and stop the fears? I think it's questionable. What I'm seeing now is it's a blender of a lot of forces, because you have the psychological forces. The fear of missing out can also be the fear of getting burned. And depositors are wondering, do they trust their banks? And that's why you're seeing sell-offs at like First Republic or PacWest or even Wells Fargo or B of A today. You're seeing this massive bloodletting right now in the banking sector, the financial sector. But other things are happening too that I think are scaring rather than comforting these depositors and these investors. And you've got the federal home loan banks, which are kind of the safe banks, and they're selling treasuries right now at a discount to raise $60 billion. When you see that happening, does that inspire confidence? Or does that inspire fear? Why are the federal home loan banks raising $60 billion? And when you see Joseph Biden saying everything's fine, I think it's a quote by Bertrand Russell, whenever you see a president say everything's fine, you know things are not fine. So there's this, as we talked about last time, when the math gets bad, you need to have really comforting words. And so I think this BTFP program and this exemption of the FDIC, systemic risk exemption, I think it's not going to be enough to stave off the kind of fear and the lack of trust right now in these regional banks. And I also would remind that the FDIC, even before this crisis hit the headlines last week, came out with a report weeks ago about the regional banks. And these regional banks are sitting on over $600 billion in unrealized losses in assets held to maturity and ready for sale. So there was already kind of a headline, if you were looking deep enough under the hood, to see that there are a lot of unrealized losses on these balance sheets. And then to force these banks to meet liquidity by selling their treasuries at a discount is a perfect storm. So to answer your question, Michelle, it's to be determined. I think we ain't seen nothing yet. As I've said in my last article that came out today, I think the risk could be worse. And of course, we don't know, but it's certainly not off to a good start right now.
Yeah, it's not looking very positive. And as you say, when politicians assure us that there's nothing to worry about, that's usually an indication that there is something to worry about. And, Matthew, on the psychological impact of, to borrow a term from crypto, the FUD, the fear, uncertainty, and doubt, with social media, with a 24/7 news cycle, that kind of uncertainty and fear spreads even faster than, say, in previous banking crises, right? Because if a lot of it is psychological, and if a lot of it stems from bank runs and people saying, well, maybe my bank isn't safe because this has happened, when you've got this 24/7 news cycle and when you've got all of social media pining in on this, I mean, that surely exacerbates and accelerates this idea of losing faith and losing confidence. So I know it's still early to determine, but just how bad could this contagion get?
Well, I mean, depending on who you read and who you listen to, and of course, people always think of macro thinkers as doom and gloom. I think it's just being mathematical financial realists. The question is, there hasn't been a lot of analysis right now on what's happening at the regional banks. As to your point, I don't think the average person right now in line in Brentwood, California at First Republic is there because they looked at an FDIC report on $600 billion in unrealized losses. They're there, to your point, because they're scared. The fear of being burned, right? And they're scared because it's spreading in the headlines, mainstream and offstream and other platforms. It's just a fear. And they've lost a lot of faith. This idea of losing faith is hard to quantify. I think there's a loss of faith in our government, in our finance, in our central banks, in our parties. So all of this kind of is gelling at the same time, and we're having this headline to exacerbate or add gasoline to that fire. But I think the psychological thing is the most important fear. There are some who think you're going to need trillions to back out these, to support these regional banks. And again, when you see fear spread, it's very hard to know under each balance sheet. We haven't done a lot of analysis yet. I haven't seen good analysis of all the regional banks' balance sheets. But when you see the federal home loan, banks selling treasuries at a discount just to make their clients confident, I think that actually creates more fear. Why are you selling treasuries if everything's fine? Why are you worried about liquidity if you're fine, if your balance sheets are fine? And even at Credit Suisse, which is not part of the headlines right now, before SVB imploded and before Silvergate went into liquidation and before, these other banks are now making the headlines, Credit Suisse was already gasping for air here in Switzerland, gasping for air. They wouldn't even show their cash flow statements. And their stock was down 60% last week. So it's a zombie bank. And I think when you have those headlines at Credit Suisse, you have the memory of Bear Stearns and you have the memory of TARP and you have the memory of bailing out bad banks. And now you see Sam Bankman-Fried ripple effects in Northern California affecting these banks. There's just a real what the hell kind of attitude. What's really going on? And again, will 25 billion or 38 billion or 500 billion or 800 billion or 1 trillion restore confidence? If it does, it will be at the expense of the Treasury and the US dollar. So again, we're in a situation where the average investor probably isn't thinking larger macro themes. They just don't trust. And that's fine. That's a very powerful thing. It's hard to talk about as a pundit to measure and quantify trust. But we can talk about what the long-term ramifications are going to be for the Treasury market and for the US dollar and the invisible tax, which is inflation. Because remember, whatever bank we're looking at, whether it's a major bank like JP Morgan, which has trillions in depositor funds, or SVB, which failed with 170 billion of depositor funds, banks, when the cost of funding their operations is less than the kind of value of the earnings of their assets, they have a problem. And because the Fed has raised rates so high, bond prices have fallen so high that the yields on bonds are higher return than the depositor rate you're going to get in your checking or savings account. So when the yield on a 10-year or a longer term bond is higher than your checking account, why would you want to be a depositor? This then forces banks to enhance their deposit rate so they can compete. But even when they enhance that deposit rate, again, it's still a negative return when you have inflation. So all these forces gel together. And if banks have to raise their deposit rates, that's going to affect their balance sheets. That's going to affect their margins. And then they're going to have to issue more shares, which dilutes their shares. So it's a vicious circle, all coming back to rising rates, an artificial policy pursued by Powell some time ago to look good in front of inflation, and yet ignore all the consequences in all the markets, including now the banking sector.
Right. Well, as you say, a number of factors have been feeding into this monster, and it's still to be determined just how frightening it'll get. Back to Powell. I mean, we've been saying that the Fed will hike until it breaks something, right? So is this the thing now that the Fed has broken? Is this now what is going to force the Fed to stop raising rates, or at the very least slow down?
Well, the Fed has broken a lot of things already, and this is certainly, I think, the biggest break to make headlines in over 16 to 17 months. I mean, even Goldman Sachs, which was the hawkish bank on Wall Street and so proud to be fighting inflation, which I think was a fiction, but to be fighting inflation and really supporting this QT policy without any regard for the ripple effects and the collateral damage. We already saw the stock and bond markets last year have their worst nominal return, stocks and bonds, correlated since 1871. So that's already pain. We haven't really solved the inflation problem, however it's measured, because it's still a problem. It's still persistent. Remember, Powell was the same one who told us not long ago that this was transitory. Do we really trust Powell? But to your larger question, I mean, even Goldman Sachs now says, I don't expect a rate hike in March 22nd this month. We don't see it. Jeffrey Gundlach, don't even count on it. The question is, will a pause in rate hikes be followed by a pivot to more QE? And already the joke on Wall Street, already in less than 72 hours, this BTFP acronym, which is like TARP 2.0, Wall Street's just calling it by the freaking pivot, because what they're expecting is Powell's going to have no choice now because he has broken something. We'll see if this BTFP program will put enough glue on the egg to fix the broken egg. If it isn't, he's going to not only have to pause in March, he's probably going to have to pivot like he did. We did in 2018. We were raising rates all through 2018. We had that Christmas massacre. 2019, there was a pause. 2020 was unlimited QE. The question is that going to be credible anymore? Can we narrate that from DC to bail out banks at $1 trillion or $2 trillion level again without just creating pitchforks in the streets? No one wants to see bad banks, good banks, questionable banks bailed out again. And the only way to bail them out, of course, is through mouse click money, which is inherently inflationary. So there are so many forces at play here, Michelle. And
it's mouse click money that got us into the situation in the first place, this unprecedented monetary and fiscal stimulus that we've been seeing, excessive spending from government. And as we said, a lot of stimulus to follow the COVID crisis in order to get the economy bouncing back again. And then we had Powell assuring us that inflation was transitory. And we were calling him out for that then. But now we have a situation where it's clearly not transitory. And just last week, we had Powell saying that he needs to go harder and faster and for longer, that he planned to be more aggressive and speed up rate hikes to fight inflation. Can't do this now if everyone is assuming, including you, that there's going to be a pause in March. What does this mean for inflation then?
Well, again, I think this is maybe controversial or less so. I've written about this, spoken about this many times. My strong belief is Powell was never going to beat inflation with rising rates. First of all, even if you assume that the CPI is a legitimate scale, which we all know it isn't, but even if you assume 6.1%, 6.5% CPI is accurate, he's not going to beat that unless he raises rates to 7%, which the markets can't handle. I never believed for a second that Powell was fighting inflation by raising rates. I think he optically, because the Fed is a political instrument, it is not independent, it is part of politics. It's probably more powerful than the White House. But Powell's plan was not to fight inflation. He had to say that. He had to put up a valiant effort. He wanted to be Volcker 2.0. He wanted not to go down as Arthur Burns. But the real issue for Powell was, in the case of another recession, he needs some ammunition, something to lower, something to reduce, or something to pivot when we are really facing the wall, when the blindfold and the cigarettes are on and we're really in trouble. Will he have enough rate hikes that he can reduce in a time of a real crisis? I never thought he was trying to raise rates to fight inflation, because every debt-soaked nation throughout history, pre or post-capitalism, pre or post-democracy, when their back's against the debt wall, they need negative rates. They need inflation to be higher than interest rates. They need to inflate away their debt. And that was Powell's real mission all along. He was never going to beat inflation. Wonderfully, he could misreport inflation, but it was never about inflation to me.
Okay, so what does that mean? Does this mean that we need to get used to a new normal of inflation at what, 6%? Some have even come on this show and said, expect inflation to hit a new normal of 8 to 10%.
Well, I think if we use the Volcker scale of 1980s, we're already at 12 to 13%. We feel that on the streets. We feel that. That invisible tax is hurting us all. It's really hurting the middle class. Even the Fed is now looking to maybe have a target rate of 4%. You have to recognize all the time, this is not conspiracy theory. The CPI scale is disingenuous. It's not even an accurate measure. But I think we certainly can expect more inflation. If we have a recession, that's definitely disinflationary. But the real definition of inflation from Morton Friedman to my business school books is money supply. And though we've been galvanically happy about reporting a 500 billion reduction in M2 money supply, that's so out of context because we've had a 14 trillion rise in the M2 money supply since the last 15 years, and even reducing the Fed balance sheet by 2% last year. What did that give us? Not much. We didn't really beat inflation, and we caused the markets to crash, to historic levels combined, stock and bond. The risk parity portfolio was a joke last year. So I don't think we've beaten inflation. I don't think our aim is to beat inflation. I think inflation is here to stay. We need inflation in a debased currency, not a relatively strong currency, but a debased inherent currency to beat inflation. So I don't see inflation going away. I see disinflationary forces, but I don't see it going away. I think inflation is necessary to inflate our way out of debt. And I think when it comes down to choosing between the markets and the dollar and the currencies are always the last bubble to bust. We had a subprime crisis, we had a real estate crisis, we had a NASDAQ crisis, we had a tech crisis, stock and bond crisis. The last bubble to burst will be the currency. And when push comes to shove, and when we're in a recession, whether it's officially recognized or not, every nation throughout history has to weaken its currency and reduce rates, because you can't beat a recession with rising rates and a strong dollar. So they're going to have to use this crisis as a pretext to manufacture more mouse click currency, to debase the inherent purchasing power of that currency and inflate away their debt. And of course, blame this on a weird tech reaction, Putin, of course, COVID before, global warming, coal plants, whatever they need. They'll never blame it on the actual patient zero of this whole thing, which was an addiction post-2008 to money on demand that's not tied to an actual service or an actual asset. And it's just debased currency. That's how I see it. That's inflation to me.
And that is probably why we've seen gold rising on this news. We had gold rallying today. It's up around 3% at the time of this interview, back over 1900. So what is the impact on the gold market here?
Well, again, there's so many forces affecting the gold market, and we can talk about that too long, and I could get too long into it. I think the main thing I think about gold, and I was always a stock bond freak. That's how I came up until I had mentors like Egon, private mentors like Egon, who taught me about the real value of money. And now instead of being a mentor, he's a colleague. But remember, decades ago, folks like Egon, he wasn't alone, but he was one of the pioneers who had made a lot of money on the public markets in a FTSE 100 company, recognized that it's the currency's purchasing power that is the real issue, given these debt cycles. When he was investing in gold, it was $200, $300. It's gone to $400, $700, $800, $1,100, $1,800, $2,000. It's always a subject of debate. It's just that silly little bar that stares at you from the ground and does nothing, that barbarous relic. And I would argue, and I've learned, and I have no doubt in my mind, now that all these currencies in circulation, whether they're mouse click printed, levered, hypothecated, buried in the repo markets, buried in the euro dollar markets, buried in the derivative markets, all these currencies that are spinning around and not sitting in the ground are losing value, whereas gold just sits there and it doesn't get stronger. It's just currencies get weaker. And yes, there's the COMEX trade. Yes, there's the LBMA banks. Yes, there's manipulation of the spot price of the paper price of gold. All those things are true. But at the end of the day, would you rather want your fiat or digital joke currency at bank X, Y, or Z, or would you rather want an actual bar of a finite asset with unlimited duration that you own in a private vault as opposed to a beleaguered bank? For me, Egon was right 20 years ago, and he'll be right again tomorrow. It's just, as Rick Rule said, I think it was brilliant. He was talking about silver, but I think it's a true thing. When you step outside of all the smoke and noise, all the gun smoke, all the debates, QT, QE, inflation, deflation, markets, sectors, it's simply too much debt and too much debased currency, and precious metals reward infrequently but extravagantly. For the patient investor who's not a speculator, who understands currency risk, it's not a gold bug analogy. It's not a gold bug narrative. It's not a gold bug apology. It's common sense. And so it's really not important to me where the dollar is vis-a-vis gold, or where the yen or the pound or the euro or the peso, because these are all worthless currencies to measure by. It's the gram, it's the ounce, it's the kilo. I'll say it 1,000 times. The reason gold was hurt against the dollar was temporarily strong in 2022. And I said throughout the year, that's temporary, because they can't sustain a strong dollar policy. And we're seeing that crack right now in the banking crisis. I really do believe if they don't contain this psychological fear, they're going to have to resort to a pivot at some point, a pause, then a pivot, which is inherently debasing the dollar. And the dollar will get weaker because the recession will demand it.
Okay, so patience and infrequently but extravagantly is what the gold investor can anticipate here. But Matthew, we have, as I say, gold rallying a little bit now. When do you think the sentiment reaches the market in terms of seeing this really come up in the gold price? When do you think this fear, this lack of faith, this understanding of what you're saying really starts to hit home and we have the price of gold, for starters, break 2,000?
Yeah, even last year, even Goldman's commodity advisor was saying gold hit 2,500 last year because you had inflation, you had global geopolitical, you had war. Why wasn't gold ripping last year? Well, again, that was because of the strong dollar and Powell's deliberate policy, artificial policy to make the dollar so strong, and that was a real headwind for gold. And of course, all the other COMEX mechanizations. I think when you're talking about gold, there's a lot of forces. I think ultimately, and it's a vague, amorphous, kind of Pollyannish answer. Faith is very hard to quantify, and I've written about this many times. When faith in the system, not just faith in the currency, but the systems, dilutes and weans, then you finally see a recognition of gold's role and value. I think for a long time, the argument against gold was the inflation was just temporary. Then that disappeared. Well, no, now it's the strong dollar, so gold was still held back. Well, now that strong dollar narrative is about to shift, in my opinion. It's not sustainable. That was just math. That wasn't even a view. It was just math. You can't have a strong dollar into a recession. At some point, something was going to break and the mouse click money was going to come. So the temporary inflation narrative held back gold for a while. Then it was a strong narrative that held back gold. I think both those narratives have no more legs or less legs. And I think when people start to really question the talking points that worked against gold in these otherwise profoundly important environment for gold, then gold will start to rip. It's a mug's game, as Egon says, to predict the quarter, the month, or the year. If it's next year or next morning, it's irrelevant to me. I have no doubt that the dollar in my pocket, if I put it there and come back in 2 years, it'll be worth a lot less than the gram of gold I have in my pocket, or the ounce, or the kilo in the vault. And so I think all of our clients of all very high income levels, but of all sophistication levels, understood this. It was never about selling at a high or selling at a low. It was just hold. It was hold, because they trusted that simple piece of metal, monetary metal, a lot more than that paper or digital currency at Bank X, Y, or Z.
But I still like for you to give me an actual target that you think is realistic for gold this year. Is it safe to say that you think gold is going to hit a new all-time high this year?
I think it is. I think the only thing, I can't see what could stop it. I can't see how a stronger dollar will stop it this year. I don't know how the dollar could go stronger. I don't know how Powell, after what just happened last weekend and this week and today, how Powell could continue to really be hawkish and go 25 to 50 bips every quarter. I don't know how it can work. It's certainly, if he wins the war on inflation, it's going to be overlooking a rubble of the bond and stock markets and of the economy. It's a Pyrrhic victory. Something has to stop him. I also think Yellen, unlike Powell, knows that demand for U.S. Treasuries has sank because rising rates didn't attract more investors. It forced a sell-off of U.S. Treasuries globally. It was the opposite effect. Like the sanctions, it totally backfired, the strong dollar policy, because countries from third world economies to Japan had to sell their reserves of treasuries to get liquidity to booster up their own economies and their own currencies and their own markets. So the strong dollar, high rate policy backfired. And the US Treasury market was the unloved belle at the ball. No one wanted to dance with her anymore. And so Yellen, ironically, this matriarch of toxic money, is stepping back up. Former Fed chair, now Secretary of the Treasury, that's ironic, is now really calling for more liquidity. Powell was trying to puff his chest with this strong dollar policy and this high rate policy, but it was killing the Treasury market. It backfired. We were not seeing more natural demand for treasuries. We were seeing sell-offs in treasuries. And the U.S. lives off its IOUs. If no one else is buying Uncle Sam's U.S. treasuries, who's going to buy it but the central bank? And how are they going to buy it? By printing money, which is going to be inherently inflationary and debasing of that greenback.
All right, but
so the target that could be 24, 25, 2600. I don't know if it'll be this quarter or next. The only thing holding it back was the strong dollar and, of course, the LBMA market, which we talked about in our last conversation, even that Moscow World Exchange, Moscow World Standards. There's a movement of thinking of fair pricing and de-dollarization. These are all tied to the sins of the Fed, which we can get into, but they're all tied.
Of course, and there are a whole lot of geopolitical developments happening at the same time. This is not happening in isolation. There are big crises on the global stage, which I want to get into as well. But just to recap here, you're seeing a pause in March and then a potential pivot by when? Last time we spoke, you said by September. Do you see a pivot as in starting to cut rates sooner, or are you sticking to September?
I mean, sticking to a particular month, I definitely see a pause in March,
Yeah.
definitely. And they'd have to have a miracle. I can't imagine them hiking after this crisis. I see a pause. The question will be, did they contain the emotional, psychological fear more than just the balance sheet fear? They're all related. I don't know if they'll be able to contain that. We'll be watching that. If they don't, there's going to be, just like there was in early 2019, a move from a pause to a pivot. And then, when the COVID crisis was unlimited, we'll just see how big the crises go. But I definitely see a pause in March and probably an eventual pivot by the end of the year if this contagion spreads. And
Yeah.
and more, and we'll see, because de-dollarization in the U.S. Treasury market, the need to print more money to buy our own debt is going to become insurmountable probably by the year end. There's so many converging roads here.
And it's interesting because you have markets rallying on expectations of a Fed slowdown, but
Of
it
course.
seems like Wall Street is being too dismissive of the bigger concern to the broader system and the bigger concern of the impact of inflation and recession. How do you explain this rally? Is it just like very short-term thinking?
It's a sad analogy. It's addiction. When you're addicted to a certain toxic chemical or toxic inebriator or upper, you think it's always going to help you. And I think the good news is bad news motif is back. Well, this banking crisis is going to force the Fed to pivot to QE. That means more instant liquidity. That means a jump in risk assets. In fact, traditionally, the move to QE can be followed by a major sell-off, because now more and more investors are saying this is not going to work. The question is, will another QE actually work? Even if it does, if the markets go up 10, 15%, inflation is going to eat away at that. You're running uphill in roller skates now, because there's been too much money printing. There's been too much support. There's been too much addiction. And these addicts, including investors, not just central bankers, investors are drunk on the notion that QE will save them. As if, like we joked last time, so many martinis, at some point, they lose their taste, their flavor, and their high, and you're just sick. And
I'm,
I
I'm,
think
I'm smiling at the metaphors, Matthew, because you have the most colorful collection of metaphors, and I'm trying to remember them to use them in my own conversation. Running up the hill in roller skates, I like that one. Again, nothing positive, but the metaphors are certainly very inspiring. Look,
Yeah.
Matthew, we've also got this in the context of the debt ceiling, right? I mean, the US has already reached its debt ceiling limit, which they'll have to raise by June, or the US will default. How does this potential fallout to the economy from this crisis now impact the debt ceiling crisis?
Well, nobody's going to be surprised. That's not a glass ceiling. It's a paper mache ceiling. It'll be busted. They'll go right above it. They'll have no choice. They'll fight about it. They'll each get their 30 seconds of fame. Each politician, left or right, will show how strong they are and how worried they are. And then they'll vote on a debt ceiling increase, and they'll increase their deficits. And to pay for those deficits, we're going to have to sell more U.S. Treasuries. There's going to be less demand for those U.S. Treasuries if the dollar stays strong. So they're going to have to mouse click money to pay for them and monetize their own debt. So all of these things come back to forcing Powell through, despite all the politics and optics of 2022, all of these things are going to force the reality to hit him that no one else is going to buy our treasuries if you keep raising rates like this. And then you have the debt ceiling theme, and then you have the de-dollarization theme and the movement away into other cash settlements. And of course, you have the petrodollar disaster. All these things that happened in 2022, they come home to roost, just like all the layoffs that, in the employment numbers and in the jobs reports, they're leading and lagging. The layoffs get reported later. What you saw at Google, Facebook, Amazon, and the business around the corner, all these layoffs are now starting to show up, just like all the consequences of all this deficit spending and debt ceiling extensions. It's easy to politically sign a document to raise the debt ceiling. What they don't know is how to manufacture GDP, bring jobs to America, keep people employed in real jobs, high-paying jobs, and solve the problem by having austerity, admitting, like you would in a family conversation, that we're over our skis in debt, honey, we have to tighten our belts, and we have to spend less and earn more and bring in real solutions, and maybe not take a vacation for the next 5 years, because we can't. American investors and a lot of American addicts in this market don't want to imagine a year without a vacation or a Super Bowl party or a jet ski, so to speak, metaphorically. They can't imagine this party is going to end, and it's going to end painfully for, sadly, mostly the middle class, who are already suffering under the invisible tax of inflation, who don't have hundreds of thousands at risk in the markets that they can afford to lose. Where many of those people in Silicon Valley, even after taking a hit and being bailed out, they can afford to lose a lot of that money. But I think it's going to be really hard for the average American, and it's sad, but it's always been that way. They're always the fodder. They're always the plankton of the big Wall Street whales. And so that's going to be frustrating. That's going to lead to possible social unrest when it just seems unfair. Another bailout at a large scale will be politically intolerable for the most Americans. I think what happened during the COVID crisis was just under 2008 bailout behind the guise of a humanitarian bailout. But as all that money was being sent into the checks and the stimmy checks, there was a massive bailout of the bond market behind the scenes in the name of COVID. But again, deficits have to be paid somehow. It's not through GDP or tax receipts. It's going to be through mouse click money.
When you say social unrest, what exactly do you mean by that?
Again, that's very hard to quantify. January 6th is a classic example of social unrest, disgust. Maybe that it was more than just about a failed election or a controversial election, whatever your take is on that, however crazy or quacky that is. The real problem is always financial. When people are broke, that's when things become political and that's when things become partisan. But the real issue, I used to always think it was philosophical, human nature, politics, but it's really basically about money. And when people are struggling and they're worried about mortgages, tuitions, and getting through the week or having a job next year, then they get very political. Then they get very emotional. Then they get angry. And that's the biggest fear. That's when governments with their backs against a dent wall become more controlling. That's throughout history. They become more controlling under the guise of something wonderfully happy, universal, like central bank digital currency. Great for cash settlements, super efficient. Really what it's about is keeping that guy with the pitchfork from having money, or a trucker in Canada from having access to funds before he can get to the capital. And I think that's a cynical view, but it's historically accurate throughout time. It's always debt crisis, financial crisis, currency crisis, political extreme, left or right control.
Well, let's talk about that, seeing as we've touched on the idea of CBDC, Central Bank Digital Currencies, which, to remind our viewers, is essentially fiat currency, which is programmable and on the blockchain and digital, and the government can see every single transaction that you make and can also program the currency potentially to work or not work in certain circumstances. Now, there is a theory out there, and you and I talked about it a little bit offline, that perhaps this is, if not a pretext, then a way that the system comes crashing down, and this is what leads to CBDCs being ushered in. Explain that.
Again, we've talked a lot about the yin and the yang of central bank digital currency. You get the official narrative, which is all warm and fuzzy. And it's true. It's a much more efficient payment system. It's a much more efficient settlement system. And that's how the Fed and the IMF and the BIS have promulgated it and promoted it. And what they're not telling you is it's an incredibly good surveillance system. And you can turn off your assets, and it's a prelude to a cashless society. It's a way to attack Bitcoin. It's all kinds of other darker motives there, but that will not come out by the Fed or by Powell. And Powell promised that it would not replace cash and it would not affect privacy rights. And that may be true under Powell, but who knows what it's going to be 5 minutes from now, 5 years from now, under a different regime, under different circumstances. They can move the goalposts whenever circumstances or national security warrant it, as you saw Trudeau do in Canada. They can create a national emergency, which is the easiest thing, national security. It's the panacea for whatever they want to do. And so the darker side of central bank digital currency is it's an invisible way to not only survey how you spend, to control how you spend, or even shut off how you spend. I'm not saying we're there yet. The question is, was this crisis engineered to grease the wheels for CBDC? I doubt it. I don't think Powell's that draconian dark. There's some who might think that, but it's certainly an opportunity. It's an opportunity to push the narration that, well, boy, if we had central bank digital currency, we could certainly fund banks like SVB and Silvergate, et cetera, faster. This would make the payment systems more efficient. Crises like Silicon Valley Bank tell us why we need central bank digital currency, and we're going to do this. Be very careful when a politician, left or right, tells you they have an instant solution that's a fiat solution that also involves technology that controls what you do, how you spend, and can turn it on and off. I don't think anyone in their right mind thinks that's a good thing.
Yeah, and as you say, if this does create much further chaos and it does start to affect the middle class, and people aren't able to afford the things that they used to be able to afford, if the government comes in and says, okay, well, we'll give you this stimulus, this injection via the form of a CBDC, just download this digital wallet and we'll instantly drop this money. If people are really hurting and suffering with inflation, they'll be much more likely to cooperate with that.
Well, better sheep than pitchforks, right? And I'm being cynical, and I understand that. That's what I would do if I were a dark force and I wanted to control more, and I didn't want to take accountability for my debt sins or take accountability for any of my mistakes and blame it all on some third party or extraneous force like a virus or an Eastern bad guy or global warming or whatever they come up with in Davos to blame what is simply a debt crisis caused by offshoring jobs to China. The American dream is made in China, and then paying for the mismatch with money printed out of nowhere. That's the
Right.
real problem. Rather than say that, admit that, confess that, and move forward with austerity and manufacturing and actual job growth, they're going to say it's something else. We're going to give you a little money. We're going to give you a little carrot. But what they won't see is this invisible paddle behind your butt that they're going to spank you with for the rest of your life. And you saw that in Canada. I mean,
Yeah.
look what happened. Again, it doesn't matter what side you take on the COVID debate or whether you're pro Trudeau or anti Trudeau. You saw how, whatever that movement was, whether you think they're all neo Nazi flat earthers with tinfoil hats or actually just frustrated people who didn't want to be told what to do with their bodies and time, whether you agree with that or not, they had the right to say something. But they didn't have the right, I think, for the government to shut them down financially with that kind of control. And that was a small sliver of what could happen at a much larger scale. I mean, this is what Davos talks about. This is what Klaus Schwab likes. He likes Chinese leadership. He actually thinks Xi is one of his favorite people. He brought him to speak at Davos. How can you say in your right mind, whatever you think of the Chinese economy, and even Trudeau has admired the control that totalitarians have, he said it publicly, how can you want to give up your freedom for a check or for a little stimmy in the name of payment efficiencies and central bank digital currency? Again, I want to get
Yeah.
off on a huge tangent on CBDC. It is a wolf in sheep's clothing.
Yeah.
Absolutely.
That's a whole other conversation,
Yeah.
which we've had on this show and will continue
Yeah.
to have. But you mentioned China's President Xi Jinping, who
Mhm.
has now entered his historic third term, by the way. So I quickly want to touch on some of the geopolitical aspects, because
Mhm.
while this carnage is going on in the United States, obviously we've got the Russian war with Ukraine still ongoing and the US continuing to fund that. We've got President Xi Jinping traveling to Moscow, reportedly, as soon as next week. Last time you and I talked, you mentioned the growing trend of de-dollarization, the potential rise of a new BRICS reserve currency, potentially backed by gold and other commodities. We've had some developments there. We know that the BRICS are meeting in Durban, South Africa this August. One of the items on the agenda is this new BRICS reserve currency. Just last week, we had China foster the restart of diplomatic relations between Iran and Saudi Arabia. Arch foes in the region are now cooperating thanks to an agreement brokered by China, which positions China, of course, as a power player. And we also know that Saudi Arabia and Iran have both applied to BRICS membership. So you put all of these sort of developments together. How far do you think we are from the launch of this BRICS potential reserve currency, potentially backed by commodities?
In a lot of ways, Michelle, you answered the question with the question. All the facts you've just outlined are just showing an inevitable growing trend that we talked about last summer. I mean, this was Grant Williams said, and I agreed with him completely in February of 2022, that moment with the sanctions, which were going to backfire, and they did, clearly, objectively, regardless of your political views or your views on the war, those sanctions were an absolute disaster. And what that did was force China and Russia to do what they've been waiting years to do, which is begin to de-dollarize. Regardless of your politics, that was always their play. They're chess players, not checkers players. They were long-term players. And this is the slow consequence of it. I said the process of de-dollarization would not be overnight. But Grant Williams was right. He said February of 2022 was as big a watershed in global markets and currency markets as August of 1971 when Nixon closed the gold window. It was an irrevocable change in the way that the dollar, it won't lose its world reserve status anytime soon, but it is already losing its hegemony in the petrodollar. You're, like you said, India meeting with Russia, China meeting with Saudi Arabia, buying oil outside of the US dollar is now not unusual anymore. It's growing trend. The petrodollar was synthetic demand to keep the dollar strong. That's going away. Demand for US treasuries is disappearing. That's going away. All the things that kept the dollar strong. There are some who say that the derivative markets and the Eurodollar markets and the US treasury markets that need to be used to collateralize those options trades will keep the dollar forever strong. I think they're looking at that in a vacuum. They're ignoring the countries that for years who have been forced to pay dollar-denominated debt as the dollar got stronger and rates got stronger. They were tired of being slaves to a bully U.S. currency. And to when you raise the price of the dollar and you raise rates and trillions of dollars are owed throughout the world in that currency, that's going to make countries not want to pay it back or look for alternative arrangements, alternative settlements, and alternative currencies. And certainly when you freeze the US treasuries of a country like Russia, when you weaponize the world reserve currency, friends and enemies alike are going to look at you and your currency differently forever. They're never going to trust it.
Yeah.
That genie never goes back in the bottle. So the process that we talked about last summer is only continuing, and it's only getting stronger. It is not overnight, but it's going to continue. And the dollar will become less and less significant, no matter what Powell says or what Biden can imagine to mutter in front of his talking points. Whatever they say doesn't change the reality of geopolitics, the reality of debt, and the slow flow from west to east. I'm not excited to see Russia and China as global leaders, but
Yeah.
it's happening. I'm not in favor of Putin or China. I'm just saying we're going to reap the sins of years of living beyond our means and trying to pay for that with money we literally print out of nowhere or muscle out of nowhere. It was a laughable fantasy, which was fun while it lasted. And the fun is coming to an end slowly. And it's happening right now this weekend and this week. And it's just another example of another crisis. Again, we've had three other prior crises in the credit markets, from the repo markets to the gilt implosion, to what happened in March of 2020. Now we have a banking crisis in March of 2023. These are just more and more sickening symptoms of a larger disease, which I really think began with Greenspan, patient zero of instant liquidity to stay elected, to stay powerful, to stay popular, and to keep politicians in office by buying every recession off with money they don't own and they print out of nowhere. It's a disaster.
Yeah, and of course, this current disaster accelerates all of the trends that you have been pointing to.
Mm-hmm.
Matthew, something to end on a more positive, forward-thinking, proactive note. Throw in a colorful metaphor in here, if you will. What can investors do if these trends are accelerating and a scenario which, again, you're not rooting for, I'm not rooting for, but seems like it is developing, is in fact going to happen? What is the way to protect yourself as an investor?
I mean, your audience is, I think, way ahead of the curve already. I'm sure from all the different interviews, and I've said this again, not talking about gold, because I wear two biographies. I was a hedge fund manager, and now I'm in Switzerland dealing with physical precious metals for a reason, the evolution. But if I were talking to investors, as I say to my own daughter, who's at Goldman Sachs, wait for blood in the streets, go to cash. Even though inflation is eating away at this rising market, even with more QE, has an expiration date. If you're young enough, you can wait. If you're old, you need to get out at the top. The risk parity stock bond portfolio, whether it's 60-40, 70-30, is correlated risk, not hedged risk. It's an absolutely disastrous portfolio scenario that many people are still in. Many RIAs are still stock and bond hedged. That's the worst thing you can do. I think if you have any ability to get physical precious metals, not ETF precious metals, and not bank-owned gold, but privately owned gold. Of course, I have a huge bias in favor of that. I also think, to Rick Rule's point, if gold does reward extravagantly for the patient, those who have the time, there are certain junior mines, and I'm not even a mining investor. I stay away from that, not because I think it's wrong. I just don't know enough. But I do know commonsensically from 30,000 feet that when gold rips, those few companies, those few junior miners, for those who can afford the risk and the time, it's something I would buy and never look at again until it makes you extravagantly happy if you're rewarding the patient. So I would stay away from risk parity portfolios. I would definitely buy physical gold as a currency insurance, not as a speculative asset. And for those that are looking to speculate and look for that Bitcoin-like return, I would look at junior miners, and I'm not even in the mining space. Again, I would just diversify into commodities. We're heading into a commodity super cycle. You've got to think of this long-term, not quarter to quarter, month to month, week to week, day to day. If you're worried about risk, absolutely go to cash, more to cash than you were before, because trying to time a top or a bottom is impossible, but we're certainly hitting a top and we're heading towards a cliff.
Why are you so anti-gold ETFs?
Because they don't really own the gold that's in them. I mean, there's so many intermediaries. There's so much hypothecated gold. The custodians of that gold are like HSBC, and those banks, we know very well what physical gold they have and don't have. They may have it on their balance sheet, but it's already lent out and hypothecated and levered in 50 different directions. So when it comes time for actual delivery, like in a case of actual liquidity at SVB or actual gold delivery at Morgan Stanley, when you need it most, it may not or won't be there. There just isn't enough gold in their deposits or in their actual control that they actually can get to you. It's all papered and hypothecated out. It's commingled. It's non-segregated. It's just not physical gold. And again, this isn't PR for my organization. There are others who do this as well. You have to own gold with a serial number linked to your name that isn't commingled, that's in a safe vault in a safe jurisdiction. and that isn't being levered. An ETF gold, they may have trusts and they may have accounts that say there's a one-to-one link for every dollar to every ounce. It's just not true, because the intermediary risk and the amount of leverage that goes on behind the scenes in the banks that supposedly custody that gold for those trusts and ETFs are bad actors. I mean, again, I'm not saying every banker is evil and every bank is bad, but they can't help themselves but use leverage and rehypothecate assets, including gold. They just don't have it. The notional value or the levered value compared to the actual net value of their gold just isn't there. And we've written a lot of articles on ETF gold risk. It's not sensationalism. It's just looking under the hood a little bit more. If you want to speculate and play gold price moves, you can use ETFs like hedge funds do, and you can use options. But if you want to insure against dying currencies, like you insure against a home or life insurance, you want to have physical precious metals purely as an insurance asset. I joke, I'm an insurance salesman. I'm not a gold speculator. I have macro thoughts and I've had a lot of experience in risk assets. But at the end of the day, what am I now? I'm a high conviction insurance salesman for dying currencies. And they're all across the board dying. The dollar is relatively strong, but as we joked last time, it's just the healthiest patient in the ICU, and its days are limited.
Healthiest patient in the ICU. What is it? Lost horse in the glue factory.
Yeah, exactly.
Yeah, you've. I like to say,
keep it simple.
I like to say, cleanest shirt in the dirty laundry basket.
Exactly. That's the same thing. Yeah.
Again, Matthew, great metaphors and fantastic analysis. Thank you so much for joining us with your insights and your analysis. Really appreciate it. As always, Matthew Piepenburg.
Thanks again, Michelle. It was a real pleasure.
All right. Thank you. And thank you for watching. If you're watching us on YouTube, remember to subscribe. I'm Michelle Makori. We'll see you next time.